Guys, welcome to MAC 3701. This is our lecture number 3. This is our lecture 3. We are going to do a practice question on direct and absorption costing, but focusing on an actual income statement. We are going to be focusing on how to do an actual income statement. Remember what I told you to say under absorption and direct costing. The question that you can expect is to be required to prepare an income statement. And we say that an income statement can either be a budgeted income statement or an actual income statement. So here we are mainly focusing on absorption, as I told you, and we'll do a practice question for direct as well after this. But for now, we are mainly focusing on absorption costing because mostly when they ask you income statement, they test you on absorption costing principles. Okay, so in our lecture number 1, we did the introduction of absorption and direct costing, and then in lecture number 2, we covered the practice question, and in that practice question, we were required to prepare a budgeted income statement. But now we want to do an actual income statement. Now we want to do an actual income statement. We want to look at an actual income statement. So lecture number 3 is basically going to be actual income statement practice question. So what are the main talking points when it comes to doing an actual statement? An actual statement is not really different from the budgeted statement. There are only 2 areas in which we might need to pay attention to, which is the first one here, which is applied fixed manufacturing overhead. With an actual statement, you have to use what we call applied fixed manufacturing overheads, and also you might be required, or you have to calculate what we call an over or an under absorption. So these are the main 2 differences between the budgeted statement and an actual statement. So I'll explain this in detail as we look at this question. Okay, so I picked a question that we're going to look at, which required an actual income statement. So this is a May June 2020, MAC 3701 May June 2020, and here's the required. Okay, let's look at the required. So we're going to focus only on required part number D. You're only going to focus on required part number D. Okay, so part D says here, assume the following 2 points for question D only for the 2020 financial year. They say the budgeted fixed manufacturing overhead. So you are given a budgeted fixed manufacturing overhead absorption rate, which is 3,850 per technical staff clock hour. It's per technical staff clock hour. I'm going to explain to you what budgeted manufacturing overhead absorption rate means and how it's calculated, so that you can understand what they mean by that. And also they said, except for point number 1 above, all the other information remain as given in the scenario. That's not number 2. Except for point 1 above, all the other information remain as given in the scenario. Then they say the required, now it requires us to prepare an actual statement, and it's for the year ended 31 March 2020. So that's the information that we need to know. Then there's also an important thing that you need to know. They said only the total column is required, which means this company is likely to be producing more than one product, but we are only required to prepare a total column, which means we are supposed to prepare the actual statement for the whole company. We're not going to look at individual products. We're going to look at the whole company. Okay, so the whole company of PW. Okay, so let's come back to the information and get to understand. So already we can write down that what is required is an actual statement, right? Okay, so actual statement. For the year ended 31 March 2020. Okay, so let's just read this first paragraph here so that we can understand what the company does, and the products that it produces and a whole lot more. So they say, with considerable financial backing from Department of Trade and financial guarantees from the national government, a prominent South African entrepreneur, Miss Cuddy, started People's Wagon, PW, being relatively new to the conventional four-wheeled passenger motor vehicle industry. PW currently, so this is important as well, four-wheeled, so they're producing four-wheeled cars. They're producing four-wheeled cars. There might be somewhere in the question that you might need to relate to this information. Four-wheeled cars. And then they say PW currently manufactures and sells two motor vehicle models, right? Which is entry level, which is the PHL, and also a sports utility vehicle, which is the SUV, right, model. Then they say which is referred to as TGD. Okay, so we've got PHL and SUV, which is referred to as TGD, vehicle manufacturing plant located in Port Elizabeth area of the Eastern Cape. Then they say the DOT's financial backing was given on the back of PW meeting a number of requirements, including making commitment to employ some of the unskilled youth around Port Elizabeth. PW uses absorption costing, so we use absorption costing, and values all its inventory using first in, first out. And then they say PW's financial year end is 31 March 20 for each and every year. So we're looking at 31 March 2020. Okay. So here they're just now telling us about the vehicle manufacturing process. They're just now telling us about the vehicle manufacturing process. They say the VPM is a combination of labor and machine intensive processes. All the manufacturing are operated by technical staff, so we've got technical staff only. So all the manufacturing machinery are operated by the technical staff only. So the technical staff only is the one that works in the manufacturing plant. It's the one that operates the machine. This one that operates the machines. Then say all technical staff are highly skilled and were all headhunted from Germany. The VPM takes place in 4 areas: metal fabrication shop, an electrical shop, a seat and upholstery shop, and an engine assembly testing shop. The process starts with building of the vehicle's metal body shells, followed by the painting of the body shells into various colors. The painted body shells are then transferred to the electrical shop for all the electrical wiring, including the fitting of entertainment centers. Seats are then fitted, whereafter each vehicle is also fitted with an engine and the required 5 wheels, inclusive of 1 spare wheel per vehicle. Lastly, each vehicle is tested for functionality. Each vehicle that undergoes the VMP is always fully completed and thereafter ready for sale. Okay, so this is just explaining to you the manufacturing process, of which there's nothing really to take out of that except whatever that I've highlighted. Okay, so remember when I told you to say you don't need to read the whole question for you to start. You only need to go and look at the information that pertains to the actual statement. So we need the information, the actual results. We need the actual results. So from note number 2 here, I can see they said summarize financial information for the year 31 March 2020. And they've given us the budgeted and the actual, which means our focus is on the what? On the actual. Our focus is going to be on the actual. So this is what we are going to focus on. This is what we are going to focus on. We're not going to be worried about what? About this. We're not going to be worried about this, but we're going to focus on the what? On the actual, because we want to do an actual statement. Okay, no, that's clear. So they gave us sales, and they actually gave us the amount for the sales. So already you can take your sales, and then they said note sales relate to note number 3.1. So let's look at note number 3.1 and see what they say. Otherwise, from my statement, I can as well write sales here. What did they say about sales? 3.1, right? So here they said notes relating to the budgeted information. So it means note number 2 is the budgeted. I'm not going to worry about that. I'm interested in note number 3.1, which is here. So they said here, these notes here relate to the actual result. So this is where my focus is going to be. 3.1 here. Okay, so they said 14,000 PHL and 5,000 TGDs were manufactured, right? Then they said 13,650 PHL were sold at 246,000 per unit, whilst 4,550 TGDs were sold. No losses were incurred in the manufacturing process. Okay, so there's no need for me to worry about calculating the sales amount here in this case. Why? Because the sales amount is already what? Is already given. The sales amount is already given. This is a given amount, so I take it as it is. So they said 5, so this is going to be 5 billion actually, 5,278 million. Okay, so sales is given. Okay, next thing is I need cost of sales, of which cost of sales has to be calculated, right? So my cost of sales needs to come in here, but I have to calculate it. But for me to calculate cost of sales, I know I need to start with opening inventory. Okay, opening inventory. What did they say about opening inventory? So opening inventory is here, right? This is what they said about inventory. They said here note number 3.2. So I need to go to note number 3.2 and see what is written there. So they say PW did not have any opening inventory, which means opening inventory was new. Then they say the closing inventory relates to the finished vehicles only. So we only have closing inventory. We only have closing inventory. They say the closing inventory relates to the finished vehicles only. So which means the inventory that is provided here is a closing inventory. This is going to be our closing inventory given. This one is going to be our closing inventory. So opening inventory was new, and then the closing inventory was given, so we need it later on. So you need to remember that closing inventory is there. Okay, so let's look at the next thing. So in this case, remember we include direct material, direct labor, then we get to manufacturing overheads. So in this case, we were given the overheads that are included. So they said here other direct variable manufacturing cost, other direct variable manufacturing cost. Okay, so that is what is given here. So they said here there's no note and we're given the amount, so we simply take the amount as it is and put it in our statement. Okay, so we're just going to, instead of writing direct material, instead of us adding wheels and other direct variable manufacturing costs so that they can become direct material or they can become prime cost, what we're just going to do is we're going to take each item, right? We're going to take item by item. So we're starting with what? This we have dealt with, this we have dealt with. Now let's deal with other direct variable manufacturing cost. So this was given. So I'm just going to use this abbreviation here that they gave us to shorten it. Which was how much? 2807. Okay, so as given here, this one needs a few zeros as well. Okay, so this is it. Remember that these are millions, right? They said 527 millions. This is very important here. This is very important to know that these are millions, right? These are millions. Yes. Okay. So this was the direct variable manufacturing cost as given. Now let's go to wheels cost. Wheels cost is part of the production actually. Wheels cost. So I'm going to write here wheels cost. Okay, so what did they say about wheels cost? we were given 6680, and then they said note number 3.3. So if you go to note number 3.3, what did they say on note number 3? Wheels were bought in accordance with the actual manufacturing requirements. No wheels losses occurred. Then they say 44 million relates to PHL and 22 million relates to TGD, but we're not worried about that because we're doing it as a total. We're not worried about that because we're doing it as a total, and the total was given, right? If you add 22 and 48 and 44, it's going to give you the total that is given here, which is 66.8. So we've dealt with what? We've dealt with wheels. Okay, so 66.8. Okay, so that is it. So let's go to the other item, which is fixed manufacturing overheads. Fixed manufacturing overheads. So this is our fixed manufacturing overheads. It was given as how much? As 250. So that's when I explained to you that when you're doing an actual statement, you don't have to take this amount into your statement. No, you must take what we call applied fixed manufacturing overheads. Applied fixed manufacturing overheads. So how do you calculate the applied fixed manufacturing overhead? You simply need to take the absorption rate, which was given here. Absorption rate, which was given in the required, which is 3,850, and you multiply it by what? By the actual clock hours. So it's going to be 3,850 multiplied by the actual technical staff hours, because they are saying here an absorption rate means that each and every technical staff hour is attracting a fixed manufacturing cost of 3,850. So if you look at our actual, what did they say about our fixed? They said note number 3.4. If you go to note number 3.4, here is note number 3.4. The total technical clock hours were 350,000 for PHL and 200,000 for TGD. 350 for PHL and 200,000 for TGD. Then they say the actual idle time was consistent 1 hour per 8 hours actually were clocked. So we're not going to worry about idle time. You use idle time in terms of calculating your variances, right? That is standard costing. So we're not going to worry about that. But now they said we spent 350 hours for PHL and 200,000 hours for TGD. So it means in total we spend how many hours? 350 plus 200,000. So it means that we're going to say the applied here is going to be 350,000 hours plus 200,000 hours multiplied by the what? By 3,850, which is the absorption rate per hour. And then the amount that we get by doing the applied overheads is 2,117,500,000. Okay, so that's the cost of applied fixed manufacturing. So when you're dealing with actual statement, you don't need to take the actual fixed manufacturing overheads. You must take the applied, and the applied have to be calculated. How do you calculate the applied? Mostly, if you're not given the absorption rate, you will need to calculate the absorption rate. I'll show you how the absorption rate is calculated at the end of this session, and I'll show you how the principle of applied works. But for now, just know that when you're doing an absorption costing statement, which is an actual statement, you must use the applied manufacturing overheads. You must not take the given actual manufacturing overheads, but you must take the what? The applied fixed manufacturing overheads. I'll explain the whole principle at the end of this session. Okay, so we now have our applied fixed manufacturing overheads. Now we go to distribution cost. We can't have distribution cost because they are not manufacturing. Now we go to unskilled staff. we go to unskilled staff. So this is going to come after the gross profit. This we have dealt with. And then unskilled staff cost. Okay, so we need to know our unskilled staff cost. They said note number what? 3.6. What did they say on note number 3.6? They said PW employed 400 unskilled staff members permanently, of which 80% were employed in the manufacturing plant and 20% were employed in the administrative staff, which means that 80% of the cost of unskilled staff is a manufacturing cost because they were working in the manufacturing plant, so it becomes a manufacturing cost. So it means 80% of that equals to a manufacturing cost. And then the 20% becomes what? Becomes non-manufacturing. Okay, so let's look at the cost now. They say the monthly actual salary pay unskilled staff member was 500 more than the related monthly budget. So it's a monthly that increased by 500. So their monthly salary increased by what? By 500. Okay, they say C 2.6 above. Okay, so if you go to note number 2.6 here, they say PW employs 400 unskilled staff permanently on a fixed and consistent budgeted monthly salary pay. Unskilled staff included in the unskilled staff cost is the holiday bonus. During December, each unskilled staff member is paid a holiday bonus that is equivalent to that staff member's salary for 1 month. So we've got two things to do with here. First of all, there was a salary increase of 500 for each and every staff, for each and every member. Then they also said that there was an increase as well, right, on the bonus. Okay, so let's work with the information here. So first of all, there's this 500 here, which is the increase, right? They said this monthly actual salary pay unskilled staff member was 500 more than the related monthly budget, so it increased by 500. Then they said the actual holiday bonus pay unskilled staff member was 500 more as well than the related budgeted holiday bonus, right? Which means the bonus also increased by 500. Then they said all the unskilled staff members were paid the holiday bonus. Okay, so let's look at the budgeted first, because they were just told that they increased by 500. So it means they increased from the what? From the budget. If you come here, you can see that we were given the budgeted unskilled staff, which is how much? Which is 54.60. So let's do this in a separate calculation so that we can all be on the same page. Calculations. Okay, C1 here. So we had the budgeted, right? Budgeted was 54. This one here, 54,600,000. 54,600. 1, 2, 3. Okay, so that's the budgeted. Now they said here, according to this information, they said the monthly actual salary pay unskilled staff member was 500 more than the related monthly budget. So it means that the increase now was how much? If it was 500 per employee, so it's going to be multiplied by 400, and it was 500 increase for each and every month, so we're going to multiply by 12 so that we can get the increase in the monthly salary, which is going to give us 2,400,000. Okay, so that's the increase in terms of the salary. Now they said here also, they said here the actual holiday bonus pay unskilled staff member was 500 more. So the bonus, which is the date check, right, was 500 more than the related budgeted holiday bonus. So it means each and everyone received extra 500 in terms of their bonus, of which this budgeted information, this budgeted amount included the bonus as well, right? So now we're just going to put into effect the increase only of the bonus. So this was the increase of the salary. And then now we are putting into effect the increase of the bonus. So the bonus increased by 500 rand, and then the bonus is only paid 1 month, which is the what? In December. So multiplied by 1, multiplied by how many workers? Multiplied by 400 workers, because each and everyone is receiving a bonus which was more by 500, which means for the bonus is going to be 200, right? Now my total unskilled labor, total actual cost, is going to be an addition of these three. Is going to be an addition of these three. Okay, so if you look at this, this is going to be the what? The total cost. So of this total cost, 80% is factory or is manufacturing. 80% is manufacturing. So that means that if you say 7 multiplied by 80%, you get 4,576, and then which means the 20%, which is the non-manufacturing, because they said it here, 80% were employed in the what? In the manufacturing plant, was 20% here were employed in the administrative staff. So you mean 20% is non-manufacturing. So the 20% multiplied by 5 billion, we're gonna get okay, so it's 11,440,000, whereas the other one is 45,700 and what? And 60,000. So this is the manufacturing, and then this is the what? Non-manufacturing. So this is part of the unskilled labor that goes into the statement before gross profit. So unskilled labor is going to be 45,760,000. 45,760,000. Let me just write it properly. Okay, so that's the unskilled labor, and then we say this is C number 1, calculation number 1. We're just referencing our calculation. Okay, so how did we get to this? It is because here, if you, let me just take you through again in case you missed that. Okay, so the first part is to understand that 20%, 80% was working in the manufacturing, and 20% was working in the non-manufacturing. 20% were administrative, 80% were in the manufacturing, right? So it means that we need to get a total cost for unskilled staff, and then we multiply it by 80% and 20% so that we can separate it, right? So that we can get the one that was working in the manufacturing. But now the amount that we have for the manufacturing is the budgeted. But now they're telling you that there were changes to the budgeted, because the budgeted was given here as what? 5460, which is a total cost including the bonus. But there were changes to this 5460. What were those changes? The changes were like this. They said the monthly actual salary pay unskilled staff member was 500 more, right? So it means for the monthly salary for each and every person was 500 more than the related budget, which means for me to get the actual, I need to add the increase here, because when they actually paid them, they paid them each 500 more. That's why we had to say 500 multiplied by what? 500 multiplied by 400 workers multiplied by 12, because the 500 increase is on a monthly basis. So that's why we had to multiply by 12 and multiply by the number of workers. so that we can get the increase in terms of the salary. Now they also said that the actual bonus was per unskilled staff member was 500 more than the related budget, and you know the bonus is only paid 1 month, which is in December or at the end of the financial year, right? Which is paid 1 month, right? So which is the 13th check. So that's why we had to multiply by 500 multiplied by 1 multiplied by 400, because the bonus is not a monthly payment. So the increase in the bonus is going to be a total of 200,000. So it means that the actual cost in total for unskilled staff was going to be an addition of all these amounts, which added up to what? 57,200,000. Now the 57,200,000 is what we need to separate between manufacturing and non-manufacturing. So we had to multiply the total by 80% to get the manufacturing, and then the total also multiplied by 20% to get the non-manufacturing. Now this manufacturing is what we need at this moment in our statement. That's why we have it here. So that was the procedure. That was what you had to do in this case. So now we have got also the technical staff cost. Technical staff cost. We were told that the technical staff cost, all of them worked in the manufacturing. All of the technical staff worked in the manufacturing, because they said all manufacturing on this point here, all manufacturing machines are operated by technical staff only. So it means that the technical staff, all of them were working in the manufacturing. So let's read what they said in note number 3.4. So if you go to note number 3.4, they say the actual total technical staff clock hours were that, PHO 200,000, and then they say the actual idle time was that. So they already gave us the cost, so it's simply going to take the cost as it is given, which is 77 here. As you can see, the cost was given 77 million. So this is technical staff. So that's 77 million is given. So now the rest is administrative management staff cost. So this is admin staff cost. It's not going to form part of the manufacturing cost. It's not going to form part of the manufacturing cost. So the manufacturing cost is what we have listed here. So this is the manufacturing cost. But remember the closing inventory, right? Remember closing inventory was given. We read that when we're doing this part here, note number 3.2, note number 3.2 here, and then it was given as 248.61. So here they said here 3.2, PW did not have an opening inventory. The closing inventory relates to the finished vehicles only. So which means this amount is only the closing inventory. So they said here 248. Okay, so that's the closing event, and it must be subtracted, so that this becomes the calculation of cost of sales. So this here becomes the calculation of cost of sales. Okay, so if we need to add everything in this and subtract the closing inventory so that we can get our cost of sales. So in adding that, you see that you're going to get a cost of sales of 4,807,050,000. Okay, so that's my cost of sales. Now sales less cost of sales, sales minus cost of sales, I'm going to get gross profit. I'll get my gross profit. I'll get my gross profit. Okay, how much is my gross profit there? Sales less cost of sales, I'm going to get 412. Okay, so that's my gross profit. But with this gross profit, now I need to consider what I call over or under recovery. I need to get whether I had an over or an under recovery, right? Over or under recovery. Let me just explain that concept in short. Okay, over or under recovery. Okay, so over or under recovery is simply the difference between your actual fixed manufacturing cost less applied fixed manufacturing cost. So we call it an over if applied is greater than what? Than actual. And an over application must be added back, right? You must add it back. It's a positive. Then we've got an under, right? Under recovery or under application. You get it if the applied is less than the what? The actual. And then this amount needs to be subtracted. You less. So if you get an under recovery, you must less. If you get an over recovery, you must add it back. So let's look in our case and check and compare. Our applied overheads is given here in the statement. Our applied as we calculated them was this much. Sorry, I need to extend this box. Okay, so our applied in this case was 2,117,500. 1, 2, 3. So looking at this now, comparing it with the actual. Our actual was how much? It was given in the statement as how much? This is our actual fixed manufacturing overheads. This is our actual fixed manufacturing overheads. They were 2,250,000,000. 2,250,000,000. So now which one is greater here? Which one is greater? Which one is it? So we can see that the actual is actually more, right? The actual is more. The actual is more. So in this case, we have what? We have an under application, right? We have an under recovery. So what we are basically saying is that we have made a provision, because this is a provision. We are saying our provision was less. The actual was more, right? So it means that for us to get to the actual, we need to what? To calculate the difference. The difference becomes the over recovery. It becomes the over applied, right? It becomes the under, sorry, we had an under in this case. It becomes the under applied. So in this case, our under applied was going to be how much? 1, if you subtract this, less that, right? We're gonna get 132,132,5. Okay, so that's the amount that we get. So that's the under recovery, and it should be subtracted. That's the under recovery, and it should be subtracted. So we are saying we made a provision of 2,117,500 for fixed manufacturing cost, of which it was less than the actual of 2,250,000. So it means we have only subtracted this much in our statement. Now we also need to subtract this much, so that in the end, if you add this and this, it will amount to the what? To the actual. So at the end of the day, we're going to have an actual profit, because we would have subtracted the applied and also the under recovery. So it comes soon after gross profit. It comes soon after gross profit. I'll explain to you how we get to the under in more detail in the following lecture. Okay, so under was how much? Under recovery. So under recovery or under applied or under absorption, one and the same thing. It was 132,500,000. Okay, so this is being subtracted. So after you subtract it, you get what you call an adjusted gross profit. We get the adjusted gross profit, which is going to be how much? This gross profit less the under recovery. We get an adjusted gross profit, which is going to be 280 million according to my calculation. Okay, so after this, now we need to subtract our non-manufacturing cost. So non-manufacturing cost needs to come here. Non-manufacturing cost needs to come here. So our non-manufacturing cost, we've got I see here we've got distribution, which is the first one. I see we've got distribution, which is the first one. Distribution here. And they said note number, there was no amount given. They said note number 3.5. They said we should check on 3.5. 3.5. Okay. So if you look at 3.5, what did they say on 3.5? So in 3.5, they said the fixed distribution cost were 5 million, while variable distribution costs were 1,200 per vehicle. So the fixed were 5 million and the variable was 1,200 per vehicle. So it means here our non-manufacturing costs are going to come in. So we're going to start with the fixed, right? Distribution. The fixed was given as 5 million. The fixed was given as 5 million. Now we need to work out the what? The variable. We need to work out the distribution cost, which is the variable. They said it's 1,200 per vehicle. So multiplied by how many vehicles did we sell? So how many vehicles did we sell? We get it on note number 3.1. We sold 14,000 PHLs. No, the actual is here. 13,650 PHLs were sold at what? 246. While 4,550 TGDs were also sold. So we sold 13,650 plus 4,550. That's the total number of vehicles that we sold actually. That's the total number of vehicles that we sold. This one was the manufactured, not sold. This was manufactured. So we manufactured more and then we sold less. So we have to add this and multiply by 1,200. So it means this is going to be multiplied by 13,650 plus 4,550 as given in the notes. So it means that in the end we're going to have a total of 2,184. Okay, let me write it down, which means we're going to have a total of 184. Okay, so that's our total. That's our total there. Let me just write it properly. So it's 21,840,000. Okay, so that's the variable. Now let's look at other non-manufacturing cost. We've got the unskilled staff. Remember the unskilled labor, the unskilled staff, the 20% part. If you still remember, the 20% that we worked out here, we said is non-manufacturing, and we've already calculated the amount as 11,440 at this point, because 20% was working in the non-manufacturing. So 11,440,000 skilled, 11,440,000. Okay, so they also gave us here administrative management staff, which they said note number 2.8, and the amount was 420. So let's see what did they say on 3.8. Sorry, it was 2.8 actually. So they said here 2.8. Since PwC incorporated the administrative staff, management staff headcount has always been 100 skilled staff. These staff members were paid a fixed monthly salary. So it means that they've always been there. So it means that there were no changes to the amount. There were no changes to that amount. So it will still take the 420,000 as it is actually given. $420 Okay, so we have to add these amounts here together so that we can get our total for the non-manufacturing, so that we can get the total for the non-manufacturing, which becomes 4582 4582. Let me just write it properly. 820. Four five eight two eight. Sorry, 828 458280. Okay, so now this amount less this amount is going to give us a loss of 178,280,000. So we got a loss, unfortunately, in this question. Okay, so that is basically what you're required to do for this part. That is basically what you were required to do in this question. So this is the whole question. This is the actual statement, and this is what you were required to do. This is what you were required to do. So I'm just going to do another video where I explain to you applied overheads, and then I also explain to you how to get under or over recover, so that you guys can familiarize yourself with how to get this amount. So our next short clip video is going to cover on applied and also on under and over recovery, how to work out these amounts. But otherwise, this is what you are required to do if you are given an actual statement. So you need to pay attention to one important thing, is that you don't put in the actual cost when you're dealing with fixed manufacturing overheads. So the fixed manufacturing overheads, it always has to be the what? The applied, right? You always need to use the applied in your cost of sales. So your cost of sales must comprise the applied if it's an actual statement. This works if it's an actual statement. If it's a budgeted statement, you just put in the budgeted. And then after that, another point that you need to note is that you also need to make sure that you include what? After gross profit, you must need to include under or over recovery, of which I've shown you how to work out an or under or over recovery. We call it under or over recovery, or under or over absorption, one and the same thing. So these are the notes on how to calculate an over or an under recovery. So the following video is basically going to expound on this principle further, so that you can understand how to calculate, or what does an applied mean, and what does under or over recovery mean, and how to calculate it. Okay, so these are the two talking points when you're doing an actual statement. The fact that you need to use applied when you're doing an actual statement, make sure you use applied, not actual. And then when you're doing an actual statement, make sure that you include under or over recovery, right, soon after gross profit. So these are the main points. Okay, so see you in our next session.